Good morning.
Good morning.
Okay, so apologies for that delay we had. Apologies for that delay we had. I had an issue with my internet, but I guess now everything is now okay. So last time we met, we were discussing on how to appraise the investment. Okay, and I think we went ahead and did an example from the past paper, if I remember. Yes, I think it should be this one. Yeah. So we did an example from the past paper on how you're meant to make the appraisal in the case how to get the NPV, okay, or project in the case, yes, from the past paper. Okay, I think we did this example. So we did case where, okay, we have capital allowances. Okay, we did an example where we do have capital allowances, okay, loss of value, or rather the tax depreciation, okay, that is provided by the government. Okay, we also did a case where we do have okay, working capital. Yes, I think we had this case also had a case of working capital. Okay, we had working capital. So today I want us to discuss what if now we do have, when it comes to the appraisal of the investment, we have inflation. Okay, what are the effects of inflation on the appraisal? Okay, that's what I want us we discuss, the inflation, the loss of value item. Okay, so let us make a simple introduction towards how do we therefore appraise in the case where there is inflation, in the case where there is loss of value of money across time. Okay, that's what I want us to discuss today. Okay, so just a simple introduction. Okay, case of inflation. Okay, the effect of inflation on appraisal. Okay, so first you know that inflation is the loss of value of money. Okay, simple as that. Okay, inflation, okay, is the loss of value, loss of purchasing power of money. Okay, purchasing power, okay, of money. Or simply the loss of value of money with the time. Okay, that referred to as the inflation. There is the loss of value or the loss of purchasing power of money. Okay, and generally, in case we do have inflation, okay, conventionally, what we have been assuming, okay, when we were appraising the projects of the company, is that there is no inflation. That is, don't forget the forecast you're doing it today, okay. Don't forget the forecast you're doing it today, okay. That is year zero, okay. By year zero, it means that you're doing the forecast today, okay. However, there's a chance that the time when you're going to actually be receiving the money, maybe a year from now, 2 years from now, what was your forecast might be different from what you are going to what to be actually be paying or receiving. Okay. So what therefore, how do we appraise in the case where you have inflation? Okay. So far, let me just go back to the previous example. Okay. We made assumption that in year one the cash flow before taxation will be 40. And we assumed that you're going to actually be receiving the 40, and maybe for every year for the next for the 5 years, for the next 5 years. Okay, that's one assumption. Okay, the reality is that your forecast might be very different. Okay, the cash we receive might be very different from what you're going to actually be receiving. Okay, because of the effect of inflation. Okay, because of the effect of inflation. Therefore, how therefore do we incorporate inflation when it comes to the project appraisal? When it comes therefore determining the value of the project. Okay, that's what so that's what we want us to discuss today. Okay. Inflation has the effect of reducing the value of cash flow, cash flows received from the project, received from the project. Received from the project. Okay. So inflation has the effect of reducing. This is reducing. This is of reducing. Okay, the value of cash, reducing the value of the cash flow received from the project. Okay. In project appraisal, we have two types of inflation. Two types of inflation. Okay, can be in A, general inflation. We call the general inflation, and B, we have called the specific inflation. Okay, so you have the general inflation. Okay, the general inflation rate, we just call it that way. And in the case of the specific inflation rate. Okay, so let's begin the first one. Okay, what if you call the general inflation rate? Okay, now the general inflation rate. Okay, this way we assume that all the variables. Okay, the selling price, for example, variable cost, fixed cost. Okay, they are going to be the inflation rate. Okay, the loss of value of the increase in price of commodity. Okay, the increase in the price of commodity. Okay, the increase in selling price, the increase in variable cost, the increase in fixed cost. Okay, is going to be at the same rate, at the same equal rate for all the variables. Okay, that's what I'm assuming in the case of the general inflation scenario. Okay, let me just begin with that. Okay, okay, case of general inflation. Okay, case of general inflation. How do you appraise in the case of a general inflation rate? General inflation, can you first simply define it first? Okay, general inflation rate. Okay, is the increase in prices or cost of variables can be, for example, selling price, for example, selling price of variable cost, fixed cost, etc. at an equal rate. Okay, the increase in prices or cost of variables at an equal rate. Okay, so all these variables, okay, selling price, variable cost, fixed cost, they all increase at an equal rate. Okay, if it is 10%, they all increase at 10%. If it's 20%, they all increase at 20%. Okay, I call the general inflation rate. Okay, okay, when appraising projects, we can estimate the net present value, the NPV, okay, using either the nominal, or the money term approach. The nominal, also referred to as the money term approach, okay, or the real term approach. Okay, so these are two different approaches that we can use. Okay, the nominal or the money term approach, or the real term approach. Okay, so we'll begin the first one, the nominal or the money term approach. Okay, so could be in one, nominal on the money term approach. Okay, so the nominal or the money term approach, so that can be therefore a first way of trying to determine the value of the project, the value of the investment. Okay, the nominal or the money term approach. Okay, so under the nominal, we need to reflect the effect of inflation on the variables. Okay, so under the nominal term approach, under the nominal term approach, the effects of inflation of course on the variables, on the different variables, on the respective variables, okay, on the respective variables is reflected is affected. The effect, okay, is reflected. Okay, same thing. Okay, so when it comes to the use of the nominal term or the money term approach, okay, so the increase in the price of commodity, okay, or the variable cost, okay, we do need all the variables, okay, that are going to be affecting the NPV, okay, that are being affected also by the inflation. We need to reflect the impact of inflation on those variables, okay, the effect of inflation on this variable. For instance, if the current price is $20, okay. Current price means that this before the inflation is $20, okay, and the annual inflation rate, and the annual inflation rate is 10%, okay, then the selling prices will be as follows. Okay, therefore, you can say that in year one, this can be year one, the selling price will be equal to, in year one, selling price will be equal to $20. But this is a year later, because this is $20 is as per today's term. Okay, so at the end of year one, the selling price has increased by 10%. Therefore, 20 times 1.1 to give us 20.2. Yes, 20.2. I'm not sure. 22 or 22. Okay, 22. Confirm.
Yes.
Okay, great. Yes. Okay, then year two, the selling price is 10% more. Okay, therefore it will be 20 times 1.1 squared, because it's 2 years from year zero from today. Okay, or the previous year 22. Okay, times 1.1. Okay, give us 24.2.
Yes.
To get 24.2. Therefore, the selling price we can say therefore in year one, year two, and the same continues all the until the nth period. Okay, the same continue until the nth period. Okay, if you want to get the nth period, selling price for the nth period will be equal to 20 times 1.1 to the power of n. Okay, where n is number of years. Okay, the power of n. Okay. That's how we do reflect the inflation. Okay, we do affect the inflation on the different variables. Okay, don't forget current price terms means that it is current price terms means is as per today's term. Okay, the current price. Okay, as the name suggests, current price. Okay, so be careful with the variables, the terms used there. Okay, because sometimes you can have variables that already we have the examiner, okay, has already affected inflation on them. Okay. But in case the variables are in current price term, then the effect of inflation is yet to be reflected on those variables. Okay, so those are some of the terms that your examiner normally use. Okay, so that's all the variables. So all the variables that are going to be affected. Okay, this can be selling price. Then in case the variables are subject to inflation, they do the same thing. Okay, if fixed cost is subject to inflation, it's the same thing. So all those variables. So all those variables that are subject to inflation, you need to we need to reflect the effect of inflation on them. So all those variables. So the first thing is note that what are the variables? Okay, selling price, variable cost, fixed cost. Okay, so your cost equals by the examiner. What variables are subject to inflation? Okay, then you need to reflect the effect of inflation on all those variables. Okay, selling price, variable cost, all of them. Okay. So once the cash flows, okay, obtained after affecting the inflation, are referred to as the nominal cash flows. Are referred to as nominal cash flow. Referred to as the nominal cash flows. Okay, so the same we did last time. We did got the cash flows. Okay, so the selling price, but now don't forget the selling price now is after inflation. Okay, variable cost is after inflation, fixed cost is after inflation. So once you effect the rate of inflation in all those variables, okay, the bottom line, the cash flows you get obtained. Okay, let me just go back to the previous example, the one we did in class together. Okay, allow me to go back there. So if, for example, okay, these cash flows were after inflation, okay, the 40, okay, if all these cash flows are after inflation, then we are referring to them as the nominal cash flows, okay, because we have already effected inflation on the selling price, on the variable cost, okay, on the working capital case, okay. So if we have been able to effect inflation on all the variables above, okay, then the cash flow we have here, these cash flows here are what we refer to as the nominal cash flows, okay. We're referring to as the nominal cash flows. Okay. Okay. The cash flow obtained after effecting the inflation, okay, referred to as the nominal cash flows. Okay. To obtain the NPV, to obtain the NPV, we'll call the nominal NPV, the nominal cash flows, okay, are discounted at the nominal rate of return, That once you have now the nominal cash flows, we discount them at the nominal rate of return. Now the question is, what's the nominal rate of return? This is a return that the investors, okay, the person who will be financing the project, okay, will be expecting, okay, after they have, based on is the return they'll be receiving, okay, after the effect of inflation, after they have asked for premium, okay, for the inflation, okay. So nominal rate of return, okay, let me just take note of it. The nominal rate of return is the investors required rate of return after rate of return is the investor required rate of return adjusted for inflation. That's time to use adjusted for inflation. Okay, it is obtained using the Fisher's equation, is obtained using the Fisher's equation. Now this is Fisher equation. It just gives us, tells us that the return, the nominal return, it's given us 1 plus n is equal to 1 plus r, 1 plus h. Okay. Now what the Fisher, this is a person. Okay, what they saying us is that the nominal return, which in this case is n here, okay, and r is the real return, okay, that in case you get an investor and your investment, okay, might lose value because of the inflation, okay, that might be experienced in that country. Of course, you'll be asking for premium because of the loss of value of money, okay. Therefore, the return you'll be receiving, okay, which in this case the nominal must be higher than the real return in case you are to invest in a market where there's no inflation, okay. So therefore, as an investor, you'll be asking for a higher return. Why? Because the country investing your money in, okay, is subject to inflation, okay. Where n is the nominal rate of return, is the nominal rate of return. R is the real return, that is the return you save in case you have to invest in a market where there's no inflation. Okay, real rate of return, and H is the general inflation rate. Okay, that once we get the nominal cash flows, we discount them at the nominal discounted the nominal rate of return, the nominal discounting rate. Okay, obtained from the Fisher's equation. Okay, Fisher's equation. Okay, the one we just created here. Clear? Nafisa is clear?
Yes, sir.
Okay, great, great. Any question? Sanya, any question?
No, sir.
Okay, great. Okay. But then you'll be asked to explain this. So I hope that you've been able to understand how you've been able to explain how to get the NPV under the general inflation rate scenario. Because as we shall go through the question bug, you see the examiner had asked this question in the past. Okay, explain how we get the NPV in case how we get the NPV in an inflationary environment for 5 marks question. So you should be able to explain this. I hope you can be able to explain. Okay. If not, let me know because you'll be asked to explain yourself. Okay. So that's how, therefore, we determine, therefore, the NPV in case you to assume a general inflation rate. Okay. So you can use, therefore, the nominal term approach. The nominal term approach. Okay. You can also use what the real term approach. Okay. You can also use what called the real term approach. Okay. The real term approach. Now let's discuss, therefore, how you get NPV in case of real term approach. Real term approach. So in the case of real-time approach, now here we are not going to is the way you normally appraise the investment. Okay, the way you've been doing it. Okay, so in this case you're going therefore to be ignoring inflation. Okay, yes, you can ignore the inflation. Okay, so therefore you're going to be appraising the cash flow. Okay, without the need for us to affect the effects of inflation on those cash flows. Okay, so like we ignore the inflation rate. Okay, we have to use in simple terms, okay, that we ignore we determine what's the NPV, okay, if we are to assume that they don't have inflation in this particular economy, okay, what would be the NPV, what would be the value of the project, okay. Under the real-term approach, the NPV is obtained using the real cash flows, The cash flows are obtained, the real cash flows are obtained. Let me just, the cash flows, real cash flows. The cash flows are obtained. Let me just correct that. The effects of inflation are not reflected on the cash flows. They are ignored. They are ignored. The effects of inflation are not reflected on the cash flows. They are ignored. The cash, therefore, the cash flows, therefore, real cash flows the real cash flows. To obtain the NPV, to obtain the NPV, to obtain the NPV, the real cash flows. The real cash flows are discounted at the real return. They are discounted at the real rate of return. Okay, so that once you have obtained the real cash flows, okay, that is the case here, we have ignored the effect of inflation on all the variables, okay. So we use the selling price as it is. So the selling price is based on the current price terms, okay. The same applies to variable costs, the same applies to fixed costs, okay. So all those variables, okay, that are subject to inflation, we ignore the effect of inflation on those variables, okay. Therefore, again, we have to be obtaining real cash flows, okay. Now, once therefore you have the real cash flows, what do? Okay, you discount them at the real rate of return. Okay, don't forget what you have just mentioned here. Okay, we need to get to know this rate to be using the real rate of return. Okay, the return the investor will be obtaining, the return the investor would have obtained. Okay, if that to invest in an environment where there is no inflation. Okay, an environment where there is no inflation. Okay. Clear? Daisy?
Yes, it's clear.
Okay, great. Okay. So that's on the how to get the NPV in case we're to assume that we have an inflationary environment, okay? An inflationary environment, okay? So let's now let me just take note here, NB. Let's do an NB, okay? Note. In the case of general inflation rate, the NPV can be obtained using both the nominal term, the nominal or the money term approach, or the real term approach. Without any material difference on the NPV, without any material difference on the NPV, material difference on the NPVs. Okay, that in case you have a case of general inflation, then you can get the NPV using both terms, either nominal or using the real term approach. Okay, and NPVs, there will be no material difference between the two NPVs. Okay, however, in case we are to have a case of the specific inflation rate, okay, I think I need to have mentioned that. I think let me mention here. I think this is something that we need to have discussed. This I think we began off with general. Yes, case of general. Okay, so we can do B now. Case of specific inflation rate. Okay, so here B, case of specific inflation rate. Okay.
Excuse me, sir.
Yes.
In the NB, we say that in case of an inflation rate, the NPV can be obtained using both nominal and real term. But in real term, we say that there is no, the inflation is ignored.
Yes, yes.
So how is it possible?
So what you want to mean by that is that when it comes to obtaining the NPV, okay, when it comes to getting the NPV, in the case of a genuine rate of inflation, okay, that is there's increase in the price of commodity. You may decide to incorporate the effect of inflation on when getting the cash flows, when get the NPV, or you may decide to ignore the inflation. At the end of the day, the NPV obtained using both the nominal, okay, or the real term approach is going to be more, is going to be equal, okay, or there'll be no material difference between those NPVs. I don't know if I've made it clear. So is it clear? Have I made sense? I hope I have.
Could you please repeat again?
So when it comes to getting the NPV, when it comes to get the NPV of the project, okay, when it comes to get the NPV of the project, you can either decide to use the nominal term approach or you can decide to use the real term approach, okay. In the nominal, you see this way of saying that you need to incorporate the effect of inflation on the variables. In the real term, you may decide to ignore the effect of inflation. At the end of the day, the NPV is obtained using the two terms, the two approaches is going to be more or less going to be equal. Okay, so there's no any difference as per se. Okay, when it comes to get the NPV of the project. Nafisa. Nafisa.
Yes.
Okay, you are the one asking the question.
Yeah.
Okay, is it clear?
Yes. Yes.
Okay. So the NPV will not be too different. Okay, that's why you can decide to use either of the nominal or the real term approach. Okay. Now, in the case of specific inflation rates, okay, how do we appraise? Okay, so first we need to therefore reflect the effect of inflation on all the variables. Okay, so under the specific inflation rate, each variable, selling price, variable cost, fixed cost, working capital, each variable, okay, has its own unique inflation rate, has its own unique inflation rate. Okay, for instance, for example, selling price can be 10%. Okay, for instance, for example, the selling price inflation rate. Let me just draw the table. For instance, you can have here is the variable. You can have here variable. Then this is the inflation rate. Okay, variable can have here selling price. The first variable, selling price, can have an inflation of let's say 4%. Variable cost per unit can be let's say 3%. Okay, can have here working capital can be increasing by let's say 10%. Okay, etc. So each of the variable therefore will be increasing at its own individual rates. Okay, so at its own unique rates. Okay, selling price 4%. So they're all different at the end of the day. All these variables that we have their own unique rate of inflation. Okay, not as an equal rate like we are in the case of the general inflation. Now, in the case of general inflation, we say that we are going to be having a case where all the variables increase by the same rate, 10%, 3%, all of them increase the same rate. Okay. However, in the case of the specific inflation rate, each variable is increasing at its own unique inflation rate. Okay. When appraising, we can appraise. We can appraise. We can obtain the NPV. We can obtain the NPV using both the nominal or the money term approach, or the money term approach, or the real term approach, or the real term approach. However, there will be material difference. There might be, okay, there might be, use that term. There might be material difference differences in the NPVs obtained. Okay, that you can get NPV. Okay, you can use both the nominal or the monetary approach. However, there might be material differences between the NPVs obtained using the two approaches. If we have remember what we just mentioned in the case of the general inflation rate, okay, we said that there will be no material differences. Okay, the NPV will be more or less going to be equal. Okay, whether you use a real term or use the nominal term approach. Okay. However, if we have a scenario where we have specific rate of inflation, then if you have to use the NPV using the nominal, okay, and the real term approach, then the two NPVs will be quite different. Okay, they might be quite different. Okay, but you can use both methods. However, they'll be quite different. The NPVs will be quite different. Okay, using the nominal or the money term approach. Clear, Elvin?
Yes, it's clear.
Okay, great. Okay, that's therefore we obtain the NPV in the case of if we are experiencing inflation in the economy. Okay. Now, I think that is it. Okay. So as I had mentioned, don't forget there's a time you examiner asked you to do this. Okay, to explain. Okay, for 5 marks. Okay, what are the key difference when it comes to get the NPV using the nominal or using the real time approach. Okay, I hope it's clear to all of you. So let's go to the question bank just to check on our examiner. Whether in September there was an exam that was done for F9 for FM, that is this for the FM, and some of the students that I was teaching for the July semester, some of them did, others didn't do, but at least one of them who did was a prize winner. So it's quite good news. Okay, it was a prize winner. I think with 67 or 65, I guess we can't remember exactly how much it was. Yeah, but one of you was a prize winner. One of your past students was a prize winner. Okay. So definitely, as I had mentioned previously, don't forget, you'll be the only class that don't get the prize winner, but I'm sure you get. Okay, so ensure that one of you get all of you, first of all of you to pass, and then at least one of you to be the prize winner, and you will be. Okay, that is in case you do as. In case you come to class, you do the RADs, you do the cards. As I mentioned, you pass. Okay, if you just come to class the normal way, you pass. However, if you want to be a prize winner, then you have to do something extra from your side. That is okay. But just to pass is good enough to come to class, and nothing more. Come to class, listen, do the assignment, do the RADs. That is enough for you to pass. But in case you want to be the prize winner, then you have to go an extra mile. Okay, that is doing your own personal studies so in the past, okay, for the many times I've remembered, since the many years I've taught this paper, we also have a prize winner. So don't be the first class not to get a prize winner. No. So looking for a question where they've been asked to discuss the differences, how we appraise in case of how we appraise in the case of inflation, how we do appraisal. It was a 5 marks question, if I remember well. If you get it, let me know. If you get it before I do, let me know. If we discuss, no. That one. Yeah, I think it should be this. Yes, yeah, it is. This is company. So HDW. Okay, this should be page 41 as per my question bank. HDW. Okay, page 41, 42. HDW, page 41, 42. Question Part B. Okay, part B of the question. Part B of the question. Let's discuss the difference between the nominal approach and the real term approach to calculating the NPV. Okay, so we meant to do that comparison, the nominal and the real term approach. Okay, so for 5 marks. Okay. Daisy, you can able to explain the difference?
Sorry, ask that question again, please.
Can you able to answer this question?
I haven't got to it. It's page 31.
The one on the screen, 41, 42. HDW company. Sanya, can you go to answer that question? Sanya? Hey, not in class. Anita, can you go to answer that question?
Yes, I can.
You can. Okay, great. If you can. Nafisa?
Yes, I think so.
You can go to discuss the differences for 5 marks.
Yeah.
Okay, great. Okay, it's good. In case you can go to answer that question. Okay. So there are 5 marks. Just simply discussing all the difference. Okay, when it comes to the appraisal under the nominal term approach, all the difference with the real term approach. Okay, so definitely you can discuss. Okay, for the case of real term approach. Okay, here we don't need first the key difference. We don't need to reflect the impact of inflation on the variables. Okay, so we use the cash flows they are using what we call the current price terms. Okay. In the case of the nominal approach, don't forget we need to reflect the effect of inflation on those variables. Okay, so once we reflect the effect of inflation on the variables, we obtain the nominal cash flows. And when it comes to get the NPV, we discount those nominal cash flows using the nominal discounting rates. Okay, as obtained using the Fisher's equation. Okay, in the case of real term approach, okay, since we have in quote ignored inflation, then we're going to be discounting those real cash flows using the real rate of return. Okay, and as we said, in case you're going to be having in case of general inflation, then the NPVs obtained using the real term or the nominal term will not be too much. There might be very minimal difference, if any. Okay, or should be equal more or less. Okay. If you're going to be using a real term approach, okay, and the nominal term approach, in the case of specific inflation rate, then you're going to be having NPV might be different between those two, the nominal and the real term approach. If you're to use in the case of specific inflation rate on the variable. Clear? Okay, so that's what we are meant to have done in that particular part. 5 marks, okay, which I think you should be able to get. Okay. So now I want us now we appraise, okay, using the nominal or the real term approach. We do an appraisal of an investment using the nominal okay, it is. This is done company page for my question mark is in page 45. Done company page 45. So done company page 45. So in part A, okay, just to fast forward, part A is asking us to get the NPV under the nominal, okay, NPV, okay, under the nominal, NPV under the real term approach, okay. So let's go through it, then we discuss together. Done company, page 45. Okay, so take 3 minutes to go through the question, then we discuss together. Okay, I suppose that you have gone through the question, so let's attempt to do it together. Okay. So you meant to get the NPV using the nominal term and get the NPV using the real term. Okay, don't forget the key difference as we have just mentioned. In the case of the nominal term approach, here we, in the case of the nominal, we need to incorporate inflation, okay, when getting the NPV. In the case of the real term approach, we don't need to ignore inflation together. Let's say that generally we do accept the two NPVs. The difference should not be that huge, okay? So the NPV should be close together, okay? Out of the two approaches. Okay, so let me get my question back. Okay, so let's get the cash flows. Okay, so you know that the revenues will be as follow. Okay, the company has taken market research costs at 200,000 in order to forecast the future cash flows of an investment. So is this market research cost relevant or irrelevant? Nafisa, the market research cost of 200,000, is it relevant or irrelevant? Nafisa,
Relevant?
yeah, relevant from Nafisa. Elvin, what do you think? Elvin, Elvin, you're not in class. What's happening today? Sanya,
So I think irrelevant.
don't forget this cost is irrelevant, okay? Because don't forget you pay for this research cost before you even make the investment, okay? It's like, don't forget, as I told you, you want to make a forecast of future cash flows, okay? So what if the forecast cash flows are bad? Do you invest? No. But do you pay for the cost? You, of course you do. Okay, therefore the 12,000 is an irrelevant cost. Okay, so it's an irrelevant cost. Okay. Anyway, so cash flows will be as follow: year 1, year 2, year 3, year 4. The cost will be as follow. Now, these forecasts are before taking into account the inflation of 4% per year. So they increase by the same rate, 4% per year. We can begin there, therefore. We are working, therefore. Okay. This is done company. Okay, so you can begin by getting the variables, okay, after inflation. So you begin here, 1, we can have here a revenue, the nominal revenue will be equal to year 1, okay, so you can begin here, year 1, year 2, year 3, year 4, okay, it's 250, the inflation is 4%, okay, there's 1 year later, 2 years later will be equal to 2570, okay, times 1.047 squared, that is 2 years later, and then to be equal to 6890 times 1.047 to the power of 3, then this 4530 1.0, this 4 years later. Okay, what do you get? Do not round off. Or you round off the nearest of 1,000, okay? Round off the nearest of 1,000. Year one, what do you get?
Uh, 1,308,750.
Okay, to the nearest of 1,000. To the nearest of 1,000. 1,000,003.
309,000.
309,000. Thank you. Year two, 2 million.
807,257.
Okay, 807.
817. Sorry.
817. Okay, 817. Okay, 17. Okay, year three, 7 million.
7,907,865.
To the nearest 1,000.
7,908.
908. Okay, year four.
5,444,000.
400.
544.
544.
5,444,000.
Or 444. 444. So 444. Okay, that's on the revenue. Now we also have the case of costs are also increasing at the same rate. Don't forget. So to cost. Okay, they increase the same rate of 4.7%. So cost here, year one, year two, year three, year four. We got 500. Okay, they increase by the same rate. Okay, year two increase by the same rate. This is 2 years later, therefore squared. Okay, year three. The power of 3 because this is 3 years later. Then 1750. Okay. Okay, to the power of 4 because it's 4 years later. Okay, get the cost to the nearest of 1,000. Okay, from year 1 all the way to year 4.
So for year two, isn't it 1,000?
Ah, it's yet. Where did I get? Oh, okay. I mixed up. So here. This is 1 million. Yes, 1,000. Yes. Thank you.
So for year one, it's 524.
Okay, 524. That's year
Year
1.
two, yeah.
Oh, okay. My pen is gone. Yeah, yes, back. Okay. So 524. Year 2.
Then 1096.
1096. Year 3.
Second. 2869.
Year 4. 2 million. 20.
2103.
103. Okay, therefore, the cost to be incurred after reflecting inflation from year 1 all the way to year 4. Then you have another variable that is also subject to inflation, which is working capital, if I remember well. The working capital will be The left working capital at the start of each year, start of year 1, year 2, okay, it will be 10% of the revenue. Therefore, we can have here working number 3 is on working capital. Okay, which means total is 10% of the start of the year. Start of year 1 is year 0, isn't it? Okay, so therefore, you can have year 0, year 1, year 2, year 3. Okay, so the investment required for working capital by the start of year 1 is 10% of the revenue of that year. There 10% of year 1. Okay, is year 1, we have it here, 1301. Okay, the thousands. Then at the working capital required at the start of year 2, which is end of year 1, is 10% of the revenue for that year, which is 2817. Then 10% of sales, that's 2909, so it's 908. Then 10% of 54444. Look at here, we don't need year 4 because the investment is calculated in year 4. Okay, the investment is calculated in year 4. So at the end of year 4, you don't need to invest. Okay, because the investment is calculated in year 4. Let's give it therefore 131 to the nearest. That is, let's give it 282 to the nearest. Then give us 791 to the nearest and 544. Okay. Don't forget what we said about working capital. Okay, what matters is the incremental working capital, the increment, what you are actually investing. Therefore, in year 0, that is today, we invest 131. So therefore, you can have another working here, incremental working capital. Therefore, in year 0, we invest 131. In year 1, that is end of year 1, that is start of year 2, we invest extra. Okay, we are topping up. Don't forget, it's a top up we're doing. Okay, towards working capital. Therefore, in year 1, how much do we top up? 150. 151. Don't forget, in year 0, already have 131. In year 1, end of year 1, you require 282. So how much do you top up? Is the difference? Is it 151? I don't know. Just guessing.
Yes, but why difference?
Sorry?
Yes, you're correct, but why difference? Why 22 minus
Okay,
4?
let's assume that you want stock. Okay, assume that this is like stock. Okay, and today, that is today, you need a stock of 131, isn't it?
Yes.
At the end of year, you require a stock of 282. Then how much more have you invested towards the stock? Do you get it?
Yes.
Yes, so it's simply the difference. Okay. Year 2, how much do you invest? 490. Or 500 actually.
509.
509. Okay, 509. Then in year 3, is the investment decreasing, the stock. At the end of year 2, the stock you had was 791. At the end of year 3, the stock you have is 554. So where is the difference? It means you have sold the stock. Okay, it means the stock is decreasing. It means therefore you have received cash from the disposal of stock working capital. Okay, how much is it? The decrease?
247.
247. Okay, 247. Don't forget these are cash outflow. These are cash outflows. Okay, these are cash outflows. But now this one is a cash inflow because you have disposed of working capital. It means you have the money in short. Okay. Then in year 4, okay, because the investment is coming to an end in year 4. Okay. Therefore, the investment we had at the end of year 3, we dispose the entire stock because this is the end of the investment. Okay. Therefore, we dispose of the entire 544 because therefore cash inflow in year 4. The start of year 4, end of year 3, we had a stock worth, let's say, 544,000. Okay. At the end of year 4, we don't need that stock. So what do you do with that? Dispose it off, okay, and obtain the money equal to 544,000. Clear? Okay, that's on working capital. That's on working capital. Okay, that's great. Next, if any question, let me know. So that's on working capital. Any other working? Yes, there's another working on capital allowances. We can therefore do working 4 on capital allowances. Okay, you can claim a capital allowance at a rate of 25% or reduce in balance basis. So year 1, year 2, year 3, year 4, the capital allowance will be equal to 25% of the cost of the investment, which is 2 million. Therefore, 2 million times 25%, a quarter of it, give us 500,000. Balance is 1.5 million times a quarter of it to give us 3 how much? 375? I don't know. Guessing. This is 5,000. Or 3H1.
$375,000.
375,000. Okay, 375,000. Then year 3, the balance is 1,125,000 times 25% to give us 2.
$281 to 50.
Sorry, 2.
281 to 50.
281 to 50. Okay. Then year 4 is the final year. Therefore, you claim balancing allowance. Year 4 is the final year. Therefore, you claim balancing allowance. Therefore, balancing allowance, that is for year 4, with the difference. By the end of year 4, the total amount you can claim is the cost minus any, is the cost of the asset minus anything that you obtain from its disposal. And now, at the end of the life of the investment, there will be zero scrap value. Therefore, there's nothing you receive from disposal. Therefore, the entire amount you spent, 2 million, and therefore the allowance for this particular asset. Therefore, how much therefore do we claim in year 4 as the balance?
$843,750.
843.
750.
750,000. Okay, and therefore the allowance for year 1 or year 4. Okay, then don't forget what matters is the savings. So therefore, tax savings is the next working. The tax rate here for this particular company is the tax rate is how much? 30%. What's happening? Yes, 30%. Okay, 30%. Okay, therefore 30% of the allowance is the saving. In the year 1, it's 150,000. Okay, year 2. You can do the nearest. Okay, you cannot do the nearest of 1,000.
So what are we doing?
30% of the allowance is tax saving. So you want to get the tax saving from year 1 all the way to year 4. Year 1, the saving was equal to 500,000 times 0.3 to give us a saving of 150,000. So I want you to do for year 2, for year 3, and for year 4. Clear?
The 113 for year 2.
113. Okay, year 3, 70.
$84,375.
84. Okay, 84. 375. Okay, so 84K. Okay, year 4.
253,125.
253,000. Okay, I got the tax savings from year 1 all the way to year 4, and I think we're done with the workings there. Anything else? I think we're done the workings. Okay, we're done. So we present our therefore our NPV therefore solution. Okay, will be equal to year 1 that have here this year 1, year 2, year 3. Do you pay tax in arrears the same year? Tax are paid, yes, 1 year. So therefore year 4. Then you also need to add it therefore year 5 for the sake of tax. They're going to be in here revenue. Okay, so I'll do them in the nearest 1,000 for my case here. So revenue year 1 was 23. How much was it? 1303. So 1309. Sorry. Okay, year 2. Let's go to 2817. Year 3 got 2908. Year 4 54,544. Okay, there is cost incurred. Okay, the cost after inflation. Year 1 524. 1096. 2869. 2103. Year 1, year 2, year 3, year 4. Okay, what do you get to be the cash flow before taxation? Year 1.
Okay, 785 the first year.
Year 2.
1721.
Year 3.
5039.
Year 4.
3341.
341. Then you pay tax. Okay, you pay tax rate of 30%, and the tax is in arrears. Therefore, tax free one is for year 2, is paid in year 2. Tax free 4 is paid in year 5. Okay, therefore, get the tax. So year 2, how much tax do you pay? 30% of 785. 2.
235.5.
So to the nearest 1,000, 2.
236.
236. Okay, cash outflow. Then tax year 3 is 30% of 1721, the previous year's income. How much is it?
516.
516. Year 4, 15.
1512.
12. Year 5, 11.
1002.
1002. Okay, it's 1002. However, you have tax savings, okay, from calculation above there. Where in the first year, the saving is 150. For here, tax savings. Look, they're also in arrears, okay? So here you have 150,000 tax saving, okay? We have 113,000. We have 84,000. And we have 84, then you have 253, then you have 253 as tax savings. Okay, then you have working capital. Don't forget, we have working capital. Working capital. It begins from year. So here we have year one. So we begin from year one. Year one we have 151. So we begin here because this is year zero. So don't confuse. This is year zero. This is year one. Year one 151 cash outflow. 151 cash outflow. Year two. Year two we have 509 cash outflow. Year three, I think we have a cash inflow, 247 cash inflow, 247 cash inflow. Then year four, we have 554 cash inflow. There's no scrap value, and that is it. Therefore, you can have here net cash flow, the net nominal cash flow, year one, year two, year three, year four, year five. Okay, so since these are nominal cash flow, we discount them at the nominal rate of return. The nominal rate of return, okay, as per the question, is equal to how much? The nominal rate of return is 12%. Therefore, we discount them at 12% year one of the year four. So we get a present value. So year one, year two, year three, year four, and year five. Okay, once we've done that, we want to get NPV, and then we equal to sum of present value of cash flows then we less the initial cost of investment, which is 2 million. Then we less working capital, which in year zero we did invest some money. In year zero we did invest year zero. How much was the investment? 130, 1,000. Okay, 1,000 minus 1,000, and we get NPV. So the NPV, and then we advise the company. Okay, so get the NPV. Sorry. What happened? Yeah, get the NPV. NPV, what do you have?
3,947.249.
That's 947.25.
Yeah. 0.249.
Okay, 49. Okay. Yeah, I guess I got something similar. Yes. Okay, let's go therefore the NPV in case we have to use the nominal term approach. Okay. Therefore, they advise the company, okay, should invest in project, invest in the project or the investment. Okay, since it has a positive NPV, since it has a positive NPV of that 947 to 49. Yes. Okay. Enough. Therefore, your praise in the case of the inflation affecting the variables. Okay. So fair enough. I think we can take a break. Then once you come back, we do how we do the appraisal in the case of the real time approach. Okay, which I think is how they've been doing so far. But either way, let's meet at 11:15 and we discuss that part. Okay. Then see you at 11:15. Don't forget to sign in case you're not signed.